with Fitch Ratings on public finances, policy and politics, the implication for debt sustainability in 2025. My name is Nikhil Sangani. I'm the Managing Director of OMFIF's Economic and Monetary Policy Institute, and I'll be moderating today's discussion. Now, shortly, you'll be hearing from an expert panel on an increasingly important topic for the global economy, the rise in sovereign debt across the advanced and emerging world. Now, this has important implications with how governments are dealing with their public finances. You'll hear very shortly about what the implications are for their credit ratings. And it seems like investors may be starting to get wary as well, given the recent volatility that we've seen in bond markets. Now, to give you an overview of the next 90 minutes of today's event, shortly we'll be hearing from James Longson, the Global Group Head of Sovereign and Supranational Ratings at Fitch Ratings, for a presentation about some of the key issues that will be shaping sovereign credit trends in 2025. We'll then be digging deeper into these topics with James and a panel of 4 experts who I'll introduce shortly, to be digging deeper into some of those key issues. Now, this, we hope, will be an interactive event. So throughout the discussions, I'll be encouraging you to pose your questions through the chat box that you can see on the side in that Slido box. And I'll try and field as many of the questions as I can to our panel throughout the next 90 minutes. Now, with that, I'll hand over to James, who will be going through a presentation.
Thank you. Thanks very much, Nikhil. And good morning, good afternoon, everybody. I will shortly share my screen and we can crack on. So hopefully we are live. Are we live now, Nikhil, with the screen?
Yep.
Yeah.
Okay.
Okay. Great. Well, thank you very much indeed. And as I say, I'm going to be talking for about 10, maybe a little bit more minutes. And the focus will mostly be, as the topic is of the day, public finance policy and also politics. And my thoughts, at least, on what we think that could mean for ratings over the course of 2025. If I move now to, I suppose it's always useful to get a little bit of context. I think on the left-hand side here, I've got a chart here that shows rating upgrades and downgrades since 2017. And I split it between DM and EM. And this effectively what you can see in 2024 was a slightly positive picture. So, but it's important, I think, to look at that in context. You know, we're talking about net DM upgrades of effectively, it's about 4, but 3 of them related to Cyprus. So really we had 2 sovereigns were upgraded in 2024 on the developed market side. That was Cyprus and Ireland. And 1 was downgraded, that was Israel. Now, if you compare that to the sort of swathe of downgrades we had in 2020, and you can see the generally negative balance we've had since 2020, really reflecting the implications of the pandemic, the strong dollar, higher emerging market debt, all these sorts of things, and tighter monetary policy. The net upgrade, the actual upgrades are relatively small in number. So in emerging markets as well, we had still a slightly more positive balance. The reasons there, a mixture of public finances and external finances. We had some upgrades for public finance reasons, relatively, the likes of Croatia, Jamaica. But we also had sort of high profile emerging market upgrades, really because of improvements in external finances. Think Egypt, for example, and Turkey. Very certainly Turkey got two upgrades last year from us. On the downside, a mixture of public finance reasons and external finance reasons on the downside for EM. But it is true to say slightly positive, but I think the message would be in the context of broadly ratings having come down quite a bit over the last several years, which is what the right-hand chart shows. Now, if you want to see put the money where our mouth is, if you like, this is, we look at the outlooks. So this is a list of our outlooks that weren't stable, if you like, at the end of the year. Now, a little bit of caution. We have about 15% of our portfolio at CCC level, so very highly speculative level, and we don't assign outlooks there. But so excluding that, this is our outlook position with 11 positive and 8 negative. So 19. This total sovereign portfolio, if you want an idea, is 120. So these are the positive and negative outlooks, but the overwhelming majority of our sovereign ratings are on stable outlook. I think that's an important message. What does it mean, negative outlook? If you want to look back in history, I look back at it for sovereign ratings between 2009 and 2023. If we had something on negative outlook, about 2/3 of the time, that translated to a downgrade eventually. On the positive outlook side, it's slightly more. I think it's about 70% of the time it resulted in an upgrade. So it's a pretty good leading indicator of the ultimate position, if not necessarily exactly when. The horizon is normally about out to 2 years for the outlook to be resolved. And I think the other important thing here, even if the numbers that aren't unstable are relatively small relative to the stable population, there's some big countries there. We've got China on negative outlook. We've got France on negative outlook. But actually, we've also got, on positive outlook, a couple of quite big countries as well, Italy and Spain. On the negative outlook side, I would say, the overwhelming common theme for the negative outlook would be public finances, deterioration in public finances, rise in government debt. So that's true certainly for all of the developed market nations. And by the way, Austria also is on negative outlook now since the year end. China, that's certainly one of the reasons. It's also true for Romania as well, which has large twin deficits. On the positive side, in terms of Italy, Portugal, Spain. Portugal's a public finance positive news story, certainly. That's been upgraded a few times over the last several years. It's on positive outlook. Italy and Spain, I think is a little bit fiscal discipline. I think Italy, certainly, we feel more comfortable around fiscal discipline. They're running primary surpluses now. We feel they'll stick to sort of the deficit procedure requirements and things like that the new ones that have come in Europe. Spain, I think it's as much as a growth potential story as anything else. And significant reduction in the sort of imbalances in the economy, improving in external finances. But we do see the sort of debt trajectory in Spain and Italy both sort of starting, so it's certainly plateauing and maybe starting to come down in the sort of medium to slightly longer term there, maybe a bit earlier in Spain. Look, the point is for this panel, public finances is certainly a big topic when it comes to the sort of ratings that aren't stable and the reasons for that. We talked about policy. By policy, we really mean US policy, I guess. So US policy is absolutely something we'll be looking at this year. It's very consequential potentially for ratings. At the top of the list, we've got trade protection. I put higher tariffs loom large. We have put in our forecast, we have some tariff assumptions. And these are the forecasts we've factored into our sort of macroeconomic projections for this year for countries around the world. And essentially they are, we've effectively gone for a 60% dutiable tariff rate on China. So goods that are subject to duties, we've ratcheted up the rate to 60%. And we've gone 25% on goods that are subject to duties for Mexico and Canada, and 10% on goods that are subject to duties for the rest of the world. So we may be right, we may be wrong. But in essence, what that does is it takes the effective tariff rate on US goods from about 2.3% to 8% globally. On China, it takes it from 10 to 35%. Canada, it takes the effective tariff rate to maybe 5% from virtually nothing. And likewise, Mexico, 2.5% from virtually nothing. So that's what we've got in at the moment. And the reason is Canada and Mexico, very few of their goods are dutiable. So clearly what we are watching at the moment is, well, what actually will be the outcome? If we have an outcome that is more favorable than those expectations, that all else equal be good for our forecasts, our macroeconomic forecasts, or less good, then clearly it will be detrimental to our forecasts when we review them. But I think maybe one of the bigger pictures points related to trade protection, but also to the persistent fiscal pressures, if I can lump them all together, if you like, is this implication for sort of the US bond yields staying higher for longer. And I think the US dollar, which has been an amazing sort of bull run, if you like, the US dollar staying strong. We think that, that has sort of broad implications across the sovereign credit portfolio. I think particularly for emerging markets, when you have a strong dollar, there's a very strong inverse correlation with emerging market creditworthiness. Clearly it makes the servicing of foreign currency denominated debt more expensive. It may mean that that sovereigns use precious foreign currency resources to support their currency. Local currency rates stay higher for longer to help mitigate inflationary pressures. All that sort of thing is sort of negative for public finances and negative potentially for sovereign ratings. So it's clearly something we need to look at. Further strengthening, staying higher for longer can bring risks about it. In terms of foreign policy, we certainly see that would be more transactional. Look, net, we do see more positive news, I think, on geopolitics. It feels a bit better in the Middle East. We've got the ceasefire. Will it hold? Well, we'll see. And clearly that would be, if it does hold, that could be good for the region, and particularly Israel. But even, and Ukraine, better mood music there. But we'll have to see how that plays out. Clearly We don't like surprises, which geopolitics can bring. But just even more, but more structurally, though, I think, and more consequentially all around, what we do expect to see is higher defence spending. That will be a headwind for large sovereigns. At the moment, if you want a rough idea, in the EU, the average defence spending is 2.1% of GDP. Now, it could be, take your number as where it might be. Some are lower, some are above that. Where will the number ultimately be? It will likely be higher. Back onto the fiscals then, what we've seen, this chart on the left takes a look at where we were in the general government balance in 2019 and compares it to 2025. Now, the main message there would be it has got worse, except outside the Eurozone. This is a very high level message. And you can see that essentially now the median general government balance in 2019 was slightly positive, about 0.25%, and it's now 2.25% negative. So 2.5 percentage point negative swing in the general government balance. Part of that is interest costs are going up, but that tends to be very slow. You can look on the right-hand chart. It's been a big deal for the US. The US interest expense is now the second largest expenditure item after social care, even more than defence. But in most countries, it's not the reason for why public finance has deteriorated. In fact, primary balances, if you want to look at primary balances, I think before the pandemic, 75% of DMs were earning surpluses on their primary balance, and now it's more like 40%. So quite a significant switch around even in the primary balances. What's been happening? Well, it depends where you look, I think. In the US, it's a mixture of revenue, tax cuts will come with that, but also, big spending. I think China's more of a revenue story. I haven't put that here, but China, it's more of a revenue story. They cut taxes way back, and also they've been getting significant lower receipts from property. But I think in Europe, it's more of a cost story, where this is where the deficits have been getting wider. Now, obviously, we might come later to where situation's been different, but where it's been getting wider, it's really a cost story, and it's about stickiness of costs, it's about inertia around costs. The average in the euro area expenditure to GDP ratio is 50%. Okay, it's 40% in the US, it's 50% in the euro area. In the pandemic, it went up by 10 percentage points, and since it's come back down by 7. So it hasn't come back down by 10. It speaks to sort of stickiness, rigidities in the system, that sort of thing. So this looks again on the left-hand side at what we can see. I talked about this a little bit. The budget balance on the left-hand side, the red line, you can see it was slightly positive on the medium before the pandemic, and it's now improved, but it's stuck at around 2.25% to 2.5% negative, which means that the general government debt balance has not, having been on a declining trend, nice declining trend since the financial crisis, has kind of plateauing. We see it, in a median basis in DM, we see it roughly flat. Now that's median. Clearly, there are big outliers. The US, China, we expect it to be increasing, but the median across DM, well, China's not DM, but the median across DM would be flatlining and not coming down. And there's some long-term structural headwinds, which I've got on the right. So that the blue bars are a median EU budget deficit, 2.8, I think it is. And I'll just put, these are purely illustrative, okay? They're not forecasts, but I put in a bit for aging. I just took the European Commission's number by 2030, maybe 0.7% aging. I put defence. I took the 2.1% median in the EU. I just made it 3. Just add it. It could be 5. It could be 2.5. I don't know. But I'm really just trying to pick up some of the headwinds. And interest, we still expect interest costs to be rising overall. It takes a long time. And climate will be a cost. I think various estimates have come up with sort of 3% of GDP. In total, clearly the private sector will pick up some of that. I put in 1%. But I'm really putting this here more as a placeholder, things to watch, rather than a hard and fast forecast of structural headwinds. Our fiscal rules, I think we often get asked about this. What sort of anchor does that mean for fiscal policy? I think it's patchy, is the way I would describe it. I think clearly, there are plenty of countries in Europe where the debt balances have been increasing quite significantly, notwithstanding the fiscal rules. But then you have good examples where in Germany, for example, where their debt brake rule seems to be a pretty reliable fiscal anchor. So I think we look at those. On the whole, they can be patchy because they can be changed or omitted or ignored sometimes. But in some places, they've been a pretty important anchor. And then bringing it all together, I suppose, projected changes in government debt ratio. I think this slide quite neatly speaks to ratings if you look on the left. Because the slide where you've got the blue lines below, this is the change in government debt ratio 2026 forecast versus actual in 2019. You can see huge improvements in Cyprus, Greece, Portugal. This is where we've seen very positive rating momentum, upgrades. I think Cyprus had 9 upgrades in the last decade, for example. Greece's investment grade again, it was double C or something in 2015. Portugal's up at A- on positive outlook. On the left-hand side is where we've got the biggest changes in government debt ratio, with China being the biggest. That's on negative outlook. It's been on negative outlook since last April. And the other one, I suppose, that would be picking up would be France, where we've got we've got that on negative outlook now. The debt trajectory there is, well, essentially we downgraded them in April 23, I think it was. And since then, sort of deficits have been a bit wider than we thought. And so the debt ratio is maybe a tiny bit worse than we thought it would be at this stage, but it's kind of fulfilled our expectations, if you like, when we downgraded it. The reason that it's still on negative outlook is we still see the political process, meaning debt consolidation, is going to be really tricky there. We've penciled in 5.4 for this year as a deficit, and still that for next year. So that would see government debt ratios, based on sort of 1% real GDP growth in real terms, still rising by a couple of percentage points a year, probably. So that's why we have that negative. UK has less debt, but we think that the deficit will come down a bit faster than that. Growth a little bit stronger than France. The debt ratio probably 12 percentage points better than France and not rising as fast. So that's on a stable outlook. The US is an interesting one. I think I'll pick that one up just to head it off before I then finish with one more slide on EM, Nikhil, if I may. The US we have on stable outlook. I think again there we downgraded them back in August 23. And since then, it has underperformed on the fiscals. Certainly, the deficits are wider than we thought they would be, but it's overperformed on growth. As a result, actually, when I compared our forecast for the debt to GDP now relative to what we did when we downgraded, it's slightly better. So it's slightly better than we forecast, like a percentage point better, so not massively than we forecast. So it's kind of lived up to what we thought would happen when we downgraded. The debt trajectory at the moment, is certainly on the up still. I think that, we would be looking for out to the medium term to see what they can do related to sort of consolidation in the medium term, the significant revenue and expenditure challenges. And clearly also the other thing we'll look at, which supports the rating at a high level for the debt level, is the reserve currency status of the US dollar. That's super important for the financing capacity and ability of the sovereign, and we need to be looking at that to ensure that that the sort of the reserve currency, the status of the US dollar stays intact with the sort of same level of reliability and credibility. And finally, on EM, I think we've got a lot on EM, so maybe I'll use this just as a tee-up one, shall I, Nikhil, and let more experts speak about it. But on EM, a similar chart I've got here, you can see here, again, the budget balance is in deficit. It still hasn't come back up. I think the most interesting thing here for EM is the significant pickup in government debt ratios. This is the median, again, but if you look back sort of 10 years, we're looking at a ratio of sub 40%, and we're forecasting it, 55-ish. So we're talking about probably getting on for a 20 percentage point increase in the debt ratio over a decade. So a significant increase in indebtedness. And I think for EM, that one of the most interesting points is the much more sensitive to interest costs. Now, we do actually, I think we have a median of 11% interest expense to revenue ratio in DM versus 3, and EM versus 3 for DM. So it's much higher structurally. And what you can see here is quite a number of EM on the right-hand chart, are absorbing large amounts of their revenues with interest expense. You can see that in the sort of the blue, the purple, and the yellow, where we're talking 20% or so are spending more than 20% of their revenues just on servicing their debt, and that includes countries like India, for example, at 24-25%. So clearly, anything that keeps rates higher for longer or whatever pushes up the US 10-year, that sort of thing would be some negative for that trajectory. And that, I think, is where I will end. So I'll stop sharing my screen now, if I can, and then we can go back, I guess.
Great.
Let me stop sharing.
Thank you very much, James. I think it's detailed and useful.
Have I come off? Yeah.
Thank you. For a really useful introduction into the topic. I think if I may, it's quite a sanguine outlook in terms of high debt to GDP ratios across DM and EM, which are not likely to rise over the medium term with some of those structural pressures that you mentioned. It'd be great to get into more detail about some of these topics with our panelists, who I'd like to invite to turn on their camera as I introduce you. So obviously we've just heard from James, part of the panel. We also have Alexander Plekhanov, the Director for Transition Impact and Global Economics at the EBRD. Thomas Friedlinger, the Fixed Income Portfolio Manager at Capital Group. Vera Songwei, the Founder and Chair of the Liquidity and Sustainability Facility. And Ernie Tedeschi, Director of Economics at the Yale Budget Lab and former Chief Economist at the White House Council of Economic Advisors. Thank you all for joining us for today's panel. And I suppose, naturally, given the week that we're in, where Trump's just been inaugurated and we're still, I suppose, waiting for some of the clear policies that come out of it in terms of the fiscal space. I wonder, Ernie, if it'd be interesting to get your thoughts initially about how you see the US fiscal trajectory under Trump, given that we're hearing a lot on tax cuts, but potentially, as James has mentioned, in the past, it seems like growth has held up relatively well, which has helped to alleviate some of those pressures on the debt ratio, at least. So, yeah, how are you seeing things shaping up?
Sure. So I thought if I might give a little bit of historical context for the U.S. and then I can talk a little bit about the risks that James touched on. So just for those of you who aren't familiar with the context of U.S. debt, so the record of U.S. debt to GDP was 106% of GDP in the wake of World War II in 1946. We are currently at 98%. So if you look at the latest Congressional Budget Office projections going forward, we would reach 119% in 2035, but that's under current law. So that assumes that the tax cuts that were passed in 2017 under then President Trump expire. We are currently under a debate to extend them, which would cost $4 to $5 trillion. If those were extended, we would actually reach 130% of debt to GDP in 2035. So well above our prior record in the wake of World War II. Remember that in the US, unlike the European Commission, we don't have a formal public mechanism for fiscal discipline here. Because I'm not sharing slides, I'm going to spare you from the equation for the law of motion for public debt. But the takeaway of that equation is that there are two reasons why debt can be unsustainable. One, of course, is just high primary deficits, which, as James showed you, definitely applies to the U.S. The last time we had an overall surplus in the United States was back in 2001. The last time we had a primary surplus was in 2007. The reasons why are a whole other webinar, but basically, the United States has been subject to the same demographic pressures as every other advanced country. We have had high health cost pressures, the same as every other advanced country. I would also say that we went through several rounds of tax cuts over the last 25 years. The other thing, I also went through a very interesting exercise where I looked at Congressional Budget Office projections back in 2000. The Congressional Budget Office back in 2000 largely anticipated the demographic and healthcare cost pressures. What they did not anticipate was, of course, the business cycles in 2001, 2008, and 2020. They did not anticipate the wars in Iraq and Afghanistan, and they did not anticipate the multiple rounds of tax cuts that were going to happen. So it ended up being almost exactly a equally divided between revenues and spending in terms of the shortfall between what they projected debt would be back in 2000 and where debt ended up being in reality. The other reason why debt can be unsustainable is because of unsustainable economic conditions. And as James showed you, I agree. The United States has actually been remarkably overperforming recently in terms of economic growth. When you look at the surprise in terms of recent economic projections against both private sector forecasters and government forecasters, such as the Congressional Budget Office, it's been roughly equal in terms of both labor supply misses and productivity misses, which is interesting when you now think about policy risk, because we're talking about policy risk possibly in terms of immigration and deportation. So you're talking about high risk of cutting off one of those policy surprises that's been driving growth in the United States over the last 2 years. The good news in the CBO projections over the next over the next 10 years is that they are projecting that nominal growth is going to continue to exceed nominal interest rates in the United States over the next 10 years. That's good news because so long as growth exceeds interest rates, you're avoiding that non-linearity that keeps debt from exploding. The bad news, and you knew that there was going to be bad news, is that that assumption is under current law, remember, which is assuming that those tax cuts expire. If the tax cuts don't expire, of course, and debt continues to pile on above and beyond those current law projections, interest rate, the more debt that we add to our load, the more that you're going to add on to interest rates in theory. And I'm sure Tom is going to talk more about that. So we add on to the risk that RNG are going to flip in the future. And as I said, if we're going to also going to add on to policies that lower G, such as immigration or imposing tariffs, we further add to the risk that RNG are going to flip into the future, which then further increases the risk of a nonlinearity in terms of debt exploding in the future. Just to put some numbers in your head, we need about $8 trillion in deficit reduction just to stabilize the debt to GDP ratio over the next 10 years, even if we don't extend the 2017 tax cuts. If we do extend the 2017 tax cuts, obviously we would need even more deficit reduction just to stabilize the deficit, the debt to GDP ratio. So that's the sort of magnitude of the problem. So let me just end by kind of putting in context where the debate is right now. Obviously, the main debate is over extending the tax cuts, which would cost $4 to $5 trillion. That's about 1.5% of average GDP over the next 10 years. That's largely expected. Even Vice President Harris supported extending most of those. I think markets largely expected that. I think what was not expected, or what has largely been uncertain, is the fiscal policy that goes above and beyond that. So President Trump talked about, for example, no tax on tips. No tax on tips has gotten a lot of ink. That's relatively small bore in the constellation of things that we've been talking about. It's highly uncertain, but probably would cost about $200 billion over the next 10 years. That's a lot of money, but in the context of the other things that we're talking about, it's one of the smaller proposals. Raising the cap on the state and local taxes that Americans can claim on their federal taxes. That's something else that President Trump promised. That's a much larger proposal. That would cost $1.5 trillion over the next 10 years. That would, or about 0.5% of average GDP over the next 10 years. That's a much more substantial proposal, and something that Republicans in Democratic states have been adamant about fighting for. So now we're talking about serious, additional debt proposals above and beyond extending the TCJA. And then as James talked about, then we have things like higher defense spending, things that are not on the radar screen.
Now, if I could just ask one just very quick follow-on from that and I think your numbers sort of state that out, but it seems like, hearing from it, it's the extension of these tax cuts to the tune of I think it was a 1 or 2 trillion that you mentioned. I mean, do you see that as the big, or what do you see as the biggest sort of fiscal growth risk? Is it those extension of the tax cuts? Is it the constriction of immigration, or some of these other policies that you mentioned? What do you see as the big risk right now out of those?
Yeah, so I mean, I think that I think that relieving the state and local tax deduction is one of the biggest fiscal risks right now. I mean, again, like the extending the TCJA, the 2017 tax cuts. That's the single biggest thing, but that was largely expected.
Yep.
There are several other things. Now, tariffs can pay for that, but a tariff proposal along the lines of what James is assuming would raise about $3.5 trillion, probably. So not enough on its own to pay for the 2017 tax cuts over 10 years. So you either have to extend the TCJA for less than 10 years, or you have to find other pay-fors, in your bill in order to make the math work, or you just have to ignore, paying for it entirely. And it's probably going to be some combination of all three at the end of the day.
Yeah, thank you. And yeah, it's a useful framework to think about that in terms of the R minus G and how those dynamics may play out. Tom, I'd like to come to you on that and how you're assessing the US, I guess, growth of fiscal situation and what the implications might be for bond markets.
Great, thank you. Yeah, so I just want to put out some, I think Ernie did a great job putting out the numbers behind it. Just some economic starting points of the US. The US deficit is about 6.9% of GDP, right? The long-term growth rate of the US economy, and this is not my numbers, this is from the Fed, from the Statement of Economic Projections, is about 1.9, and the latest one is 2.7. So the US is growing significantly above trend, significantly above potential GDP. When I was in business school years ago, we had this professor who would put up some economic numbers on the screen, and then we'd have to guess the country. If you make me guess this country, I would not say the U.S. I would probably say a country that might be in some potential fiscal problems in the future. And so I think there's some market inconsistency about this. The U.S. does have an extraordinary privilege as the reserve currency. And I think the trend post-COVID is that fiscal policy is back in the driver's seat, especially true in the US, as Ernie mentioned. But fiscal spending does have limits. I'm based in the UK. We had the Liz Truss mini budget, which was catastrophic. And the UK pound is not a reserve currency, I understand that, but it created a market crisis. And so markets do put limits around politicians in that sense. And we haven't seen this effect in the US. Obviously, the US is the reserve currency. What I call it can stay irresponsible for longer. The US exceptionalism is in full swing. Now, what does that mean? Post-COVID, the US has showed it has the highest dynamism. You see that in AI, you see that in S&P valuations. It has the highest productivity. And it has the highest amount of internal investment. If you look at where rest of world investors want to put their money, it's kind of all flowed into the US, and that was very different from the UK, where investors did not want to get involved. So this whole thing of US exceptionalism and irresponsible for longer works, but it assumes that all this dynamism continues, meaning all this AI potential productivity is still there. The productivity it continues, and the investments. Now, if that disappears, I do worry that what we call the bond vigilantes are starting to show up again and push interest rates to levels where politics has to respond to them, like we saw in the UK. Now, this is a long-term concern. I don't know what the trigger for that is, but there are some signs short-term that this is already happening. The bond vigilantes are returning. So if you take a look at since July, and this is really when Trump started to get priced into the market, I would say, the bond market term premium has increased significantly, meaning longer duration bonds have shown some sort of discount to front end. The U.S. 2s10s curve has gone from -50, so it was inverted, to +30. That's an 80 basis point move, and that's during a time when the Fed cut rates, which is quite weird and quite the opposite. So what this is telling you is the economy is strong, but I think the bond market is already sniffing at a worrying trend in the U.S. fiscal policy. And what happened in the UK is, things happen very slowly and then everything happens all of a sudden. And that's what we worry about. I don't know when that is. But as Ernie mentioned, it could be an announcement of epic proportions that are unfunded, where all of a sudden the flows stop happening. But that's the worrying trend that I have seen in the US.
Interesting to note. Yeah, irresponsible for longer is a nice phrase to use in that context. And I think in many ways harks back to James, something you mentioned, that ultimately the dollar is the world's reserve currency. There's still strong demand for treasuries in that world, and perhaps this sort of trajectory is broadly sustainable for now. It's something that at OMFIF we do a lot of work on when we survey central bank reserve managers. Over 70 of them participate in our surveys, and we've seen generally consistent demand for dollars, despite all that's been shown in recent years. We'll see what comes out of this year's survey. But James, I was wondering if you had any comments based on what you've heard from from Ernie and Tom, and yeah, about how sustainable the US trajectory is right now.
Well, as I say, effectively, what's happened so far is basically what caused us to downgrade the rating, a year and a half ago. That's essentially what we're saying, is this is basically what we're seeing now is what caused us to downgrade. But it doesn't mean to say ratings that's the we're on a stable outlook at the moment, which means we're not expecting the rating to change at the moment. But clearly we always have negative. We always have to think about what if on the downside, and we look at the debt trajectory as one thing over the medium term, some sort of medium term prognosis on the debt trajectory, and also the reserve currency status of the dollar. As I say, those become the two negative sensitivities. Failure to get then these things. Those are our two main, I suppose, downside risks for the rating.
Sure, thank you. Fira, it'd be great to get your thoughts on some of what was shared in James's analysis, or what we've heard from Tom and Ernie, is that perhaps there's rising concerns about US fiscal risks, higher for longer bond yields perhaps, and as James mentioned, that's usually a red flag when it comes to the conditions for emerging markets, particularly those that have large US denominated debt. How are you seeing those?
Indeed, I think what we are seeing now is two things, right? We're seeing, first of all, with increasing interest rates, and maybe let me go back a little bit from sort of 2008, and then what we saw in 2020, and then what we're now seeing today. Normally, what we have seen is when there is a global crisis, of course, there is a flight to safety, which means everybody comes back into the US market. But then immediately after, the market calms down, and then investors go back into the emerging economies. That has not happened this time around. Post-COVID, the investments have stayed in the United States, and this has happened for two reasons. One, because the global environment remains uncertain, and if not is worsening, so people have continued to stay in the safe zone. But secondly, the other fiscal, I think, instrument that has been used in the United States, and wonderful slides from James, that James didn't factor in, are the subsidies. The infrastructure bill, the Inflation Reduction Act, and all of that, which has actually brought more investment into the United States, taking it away, including from Europe and the rest of the emerging markets. What we are beginning to see now with a change in politics is a holdback of investments in the United States. We're not yet seeing a departure too. We're not hearing sort of investors saying, oh, we're going to leave the United States and go back into Turkey or back into India. What we are finding is people are holding and waiting to see what is going to happen. And this is also being priced into, I think, the bond markets. For the emerging markets, what is happening also is, because there was a flight to safety, if you look at countries like India, like South Africa, and others, they increased interest rates so that they could keep the resources in their jurisdictions. But as US volatility continues, interest rates continue to go up, it makes it much more difficult then to get sort of good rates of return on investment if all of the resources are going into interest rate rises. So that is actually further endangering the fiscal positions of many of those countries in a way that is not working for them either. So at the end of the day, we're getting this almost double whammy, right? We're getting sort of the sort of irresponsible, let me use Thomas's language, for longer in the United States is creating debt distress for longer in emerging markets. Despite all of this, what we have also seen in the last 2.5 years is that actually Eurobond issuances, let me go to Africa in particular, Eurobond issuances have actually grown by almost 42 to 45%. So still, countries need the investment, countries need these resources, so they're still coming to the dollar with variable rates, which are continuing to increase. So, what we have is interest spending is continuing to go up, squeezing out basic investments for growth. So we are not getting this nice, the more investments you make, the more growth you're having. We are not seeing that because a lot of the new issuances are actually just going to restructure old debt. There's no real investment happening, and there is not enough fiscal space once you've restructured all debt to continue to invest in growth. And so what we're actually seeing is actually maybe it's a triple whammy, because if you add that element to it as well, then all we're doing is, yes, we're coming back to the board, to the Eurobond or US dollar bond market, but we are not using any of those resources much more expensive, but we are not using any of that for better investment. We're using it just to maintain our credit ratings. And so we've got a couple of rating improvements we got in Cote d'Ivoire. Senegal has been downgraded. Benin was upgraded as stayed stable. I think the only one in your slide where we have negative outlook is Cameroon. So most of the other countries are kind of chugging along. Even Kenya, I was surprised I didn't see in your slide. So even Kenya is sort of chugging along. But what is happening is the risk that in the next 2 years, as you said, James, we're going to see most of that either a negative outlook or totally downgraded because the investments are not happening. The fiscal space is totally washed off because we still have for the next 2 years huge bullet payments coming in many of these emerging market economies. And if the dollar stays strong, but without sort of, the sort of positive investment story that we get when we have a good dollar, then what we are getting is, yes, the US may grow, but we will be growing in an island where everybody else is really suffering. And that does not sort of bode well for global growth, especially if China continues, as James showed in his slide, to sort of recede or not grow. They had 5% this year in the latest numbers that came out last week. We see a China that grows at 7-8%, takes Africa with it, takes Latin America with it. And so if we're not getting the 7-8% growth in China, we're getting 5%, then again, there is no fiscal space being created in many of these economies to be able to sort of contribute to global growth. And so I think when we look at the taxes and we talk about the taxes, when we talk about even the policies around climate change and what is going to happen, yes, we all complained about the subsidies, but the subsidies were better because they were stimulating innovation, which eventually was going to benefit the emerging world. If we take even that away, then productivity sort of totally crashes in many of the emerging markets.
No, very good. And I think we'll come on to climate, maybe what EMs can do in this environment.
I stopped my intervention.
No, thank you. And I think it'll help to tee up the rest of the discussion. And in many ways harks back to that slide James had towards the end about how more and more EMs are dedicating more of their resources to just financing themselves as global rates have been going up and perhaps rolling over at those higher rates now. So Ernie, you were earnestly nodding along to much of what Maria says, which I suspect you agree with much of that as well. Alex, I'd like to come to you on maybe bridging both what you've heard on Trump and maybe the implications for Europe, but also how you're seeing some of the outlook for European fiscal and public finances right now.
Absolutely. Thank you. I think actually whether we are talking about the US or whether we are talking about Europe or emerging markets, the pressures are very similar, and they were very well covered in the presentation. And I would like to throw in one more, which I think is a very real driving force beyond fiscal deficits in many countries, industrial policy. On the chart showing the greatest increases in debt, US and China were the champions in the left corner. And of course, it's just a data point. But it may not be entirely a coincidence. And in today's announcements about what is on the table for Trump's administration, we also see special vehicles for investment in AI with a $500 billion tag. Of course, they may be structured very differently, and not all of it needs to be a fiscal liability or fiscal contingent liability. But the spirit of these discussions remains. I think that distinction between the anticipated health, aging, climate with slightly different priorities, maybe the health spending may be a greater issue in the US and climate spending a slightly greater issue in Europe, but ultimately they're very similar. And then there are unanticipated ones, largely, if we go back a decade or two, defense, the erosion of peace dividend, and spending on industrial policy. But these are also very big ticket items. And they're there in Europe, but also what we show in our recent work, our last annual economic report is on industrial policy, and we show that in proportion it's the same in lower income economies. In proportion they join this race and they spend on the same. And actually, if we look also at the spreads between average emerging market yield on 5-10 year paper and US or Germany, that hasn't changed since early 2022. There were ups and downs, but on average, it's really an evolution together in a fairly global savings investment balance. And many of the emerging markets are just in a more fragile position to start with than the US. They may have more still debt in foreign currency, and namely in US dollars, then US that has the privilege of issuing in its own currency. But actually, those profiles have improved a lot. And I think what we also see both in the US and in Europe and in emerging markets is that governments have taken advantage of that period where the term premium, as has been mentioned, has been very compressed and unusually compressed, perhaps by historical standards, and now it's decompressing. But governments, by and large, have lengthened and restructured the profile of their outstanding debt. And what it means is that they have a privilege of responding more slowly now to market pressures than they would have responded in the past. And in fact, they have benefited quite a bit from the inflation surprise with COVID that actually did not immediately increase the cost of serving the debt, but brought down debt to GDP ratio. So those trends are also are there in common. And I think the ultimate question, which is a forward-looking question, is what will happen to investment savings balance globally and for the US specifically, which are very related questions, because ultimately that will determine what governments have eventually fund themselves at a flow basis. And I think that will inevitably feed back into fiscal decisions because, of course, spending and tax cuts and industrial policy and defense are necessary or popular or both fiscal responses. But then there is a fiscal constraint. And I think it's not acutely felt at the moment. But if we go to the 130% of GDP number and we imagine an interest rate of 7-8%, well, that would mean that 11% of GDP might go one day into serving that. And I think what historically has happened is that fiscal consolidation efforts kick in very strongly. I think it has been mentioned here that in 1990s and up to 2001, US has been running surpluses, but it was also time when I think Clinton administration faced interest rates exactly in that ballpark of 7-8% for longer term paper. And last decade, it's exactly what Tajikistan was issuing at. So I think I'll leave it there for the moment. I think we will come back to investment savings balance. But if we don't, I will talk a little bit about our thinking about it.
Sure. No, thank you, Alex. And I think it adds to that sense industrial policy. I think Vera mentioned climate, and James, you mentioned, Ernie mentioned demographics. So there's a lot of these structural points that are presumably only adding to some of the fiscal constraints that we're already seeing, and it's probably likely to get worse on that front. I wonder, I mean, it begs the question, what can governments sort of do to be able to alleviate some of these fiscal constraints? And James, you mentioned 3 periphery European countries where there are some positive news right now in terms of Italy, Spain, and Portugal. It'll be interesting to hear what's driving that positive outlook and how you see the differences there to maybe some of the core European countries. You mentioned France already, I guess, where there's political struggles in getting fiscal consolidation. You could argue the same here in the UK as well. How do you see that core periphery dynamic in Europe right now?
Yeah, so it's interesting. I think there's certainly been sort of economic outperformance. I think one of the things that we've looked at, and we certainly see in some of these countries, particularly Spain, for example, is they've been very good at I mean, immigration has been a lot stronger there, and they've been very good, I think, importantly, at integrating immigrants into the labour force. So you end up with a sort of double benefit, I suppose, of positive for growth, but also positive for tax receipts at the end of the day. Once you're more people working equals more tax receipts. So it's been a positive revenue story there, which I think is it does stand out. I just think overwhelmingly they've just been more disciplined on the cost side. They've just been more disciplined, and I don't know what it is exactly. I suspect it's to do with it wasn't that long ago before they were in the peak of either the financial crisis, Ireland, or the Eurozone crisis, other countries, and people remember some pretty bad things happening to themselves. And so there's general social support for running a prudent budget, a budget that's in surplus and paying down debt. Ireland is 2/3, its debt's been come down by 2/3, since its peak, after the GFC. Maybe in some of these countries, people remember having nominal wage having their wages being cut. They remember losing their jobs. Yeah, in Greece, they remember not having full access to their bank accounts for 3 years. In Cyprus, some of them might have remembered having uninsured deposits haircut. These are pretty extraordinary things that scar and run deep, and I think mean it create a sort of social acceptance, things like that, for a government to run a policy with running a surplus, a primary surplus, etc., and debt metrics coming down. And I think that's pretty important. There doesn't seem to be a whole heap of sort of political pressure, social pressure on the politicians to do it otherwise.
That's interesting. I mean, begs the question whether it necessitates a crisis or the return of the bond vigilantes before you get meaningful action, perhaps.
I think that was a really important point, the bond vigilantes one that Ernie made. I think it was Ernie that made it. I think that if there's one thing that does create discipline, the bond markets create discipline. I think, I'm sure all governments will be, awake to that.
Yeah. Just before we go to Tom, maybe to expand on some of the views on Europe, we've had a question come in on the chat box, which I think only I'll throw it your way. I guess in some ways it relates to the point of fiscal discipline in one way or another. Is there any silver lining of dealing with the US debt sustainability through the Doge initiatives and spending cuts of the Department of Government Efficiency in the US right now? How do you see that playing out?
I think it's very low hope of Doge having meaningful progress on the problem, and the reason is that Doge, as I understand the mission, is very much focused literally on government efficiency, so making government work better. It's a well-meaning and important goal taken literally. If they do their job well, it's not a goal that's going to move the dial much on the US fiscal trajectory. The problem with the US fiscal trajectory is not one of discretionary spending. Discretionary spending in the context of US fiscal language, by the way, is the piece of US spending that deals with US government operations. So US defense spending is discretionary. US employee salaries are discretionary spending. The operations of US agencies and US public parks are discretionary spending. Things like our US pension system, our US healthcare system, that is what's called mandatory spending. That's separate. That's where really most of the growth in spending is. And then, of course, our interest payments, that's a special kind of mandatory spending. Discretionary spending is growing, but that's not the primary source of growth over the next 10 years. So cutting that is not really getting at the nub of the problem. I suspect that Doge will this is purely my opinion. This is not a data-based opinion. I think they're in over their heads. I don't think they know a lot about the way that government works. I think that they're going to come up with. I think that they're going to go in, and I think that I think their final recommendation is going to be sort of a blanket sort of cap on non-defense discretionary spending going forward, which is what a lot of these types of commissions end up recommending, which will save a little bit of money, but it's not going to come even close to solving the problem for the US.
Thank you for that. And I'd encourage the audience to keep submitting their questions. I'll pose them to our panelists here. I guess coming back to Europe, Tom, I'd be interested in your thoughts on some of what we heard with Alex teeing up that point on industrial policy and defense, and then some of what James has mentioned about those core and periphery dynamics.
Sure. I'll briefly just talk about the fiscal policy outlook. I mean, I think post-COVID, we've seen a pretty big shift in mentality all over the world, but in Europe as well, which is surprising. I mean, if you look at even the most conservative fiscal governments in Europe are now more comfortable with spending. And I think that's because there's evidence that it kind of saved the day during COVID. And so that worked. And so now the question is, what is the outcome post-COVID? And I have this chart, I'm not going to put it up but it's a simple chart. You just look at how much structural or even primary deficit countries on one side, and then the growth on the x-axis. And there's a very clear pattern basically the more fiscal spending there has been, the better the growth outcomes have been. The US, Italy, Japan, even the UK are pretty high on that. They've had better outcomes. The fiscally conservative countries, that's your Germany, your Sweden, your Switzerland, even Canada, they've done less well. And so I think this is prompting governments to be more flexible with fiscal policy. I think the German election is next month. And one of the big topics is reforming the debt brake. It allows government to lead its investments. And so what does that mean for markets? I think long term, that just means real interest rates will have to go up. That's already happened in the UK and the US. Europe is slightly different. I would say the Eurozone's kind of in three buckets. I think James mentioned it pretty well. You have the fiscally conservative countries, Germany, very low debt, very low government. The debt level is actually the same as I think it was pre-COVID, and that's mainly because of inflation has kind of brought it back down. On the peripheral side, you have Italy and Spain. Again, as also mentioned, they have high debt, but also their government debt is back to about pre-COVID levels, and they've had inflation and growth, which is different from Germany, which has only had inflation. And I completely agree with James on this. These countries have historically had higher interest rates. They know how to deal with it. If you look at where Italy is, the current Italian government bond yield is 0.5% higher than it was in the decade from 2010 to 2019. In Germany, it's 1.5% higher. So, Italy knows how to deal with it. Germany might not. And I think France is in a very unique situation. It has high debt.
France and how you see that, yeah.
Yeah, France is quite unique. It has high debt, and it's actually had much higher debt to GDP even pre-COVID, about 15%. And it's had the worst growth post-COVID. And I think it's a unique situation in France where it kind of was a core country with low interest rates that are now higher. But it also has one of the largest public sectors in Europe. 20%, I think, of employment in France is in the public sector. Germany, it's 10, and Italy is 13. So this is very high. And so the wage bill made a big difference here. Post-COVID, workers demanded higher wages, and that hit France harder than the rest. And then, sprinkle a bit of political instability on top of that, and the market started to punish France. So I would say, in a nutshell, the core countries, they're starting to see they need to spend more. They're seeing the benefits of it. The peripheral countries have basically managed high rates well. They've done this before. And then France is kind of this weird outlier in the middle where it's unsustainable fiscal, has a unique government structure, and then, it has the political stability on top of it. So I think the big question for Europe will be how France will manage it through this. And I think the second question is, will Germany spend more, or Europe as a whole? But that'll really have to be led by Germany. And so I think the election next month is going to be very, very important in that context for Europe going forward.
Yeah, thank you. Perhaps France needs its own quasi-periphery, quasi-core category to add to that list. We have had a question on Sub-Saharan Africa, which I think, Vera, if you're there, it'd be great to get your thoughts on this. It's in many ways linked to the triple whammy point that was mentioned before about what countries in Sub-Saharan Africa can do to strengthen their revenue and consolidate fiscal policy and improve debt sustainability right now. I don't know if you're there, Vera, to take that question. Appears not. Maybe Alexander, come to you on the.
I think it's a great question. I think there is no.
It applies to all regions, really.
There is no silver bullet. It's those are economies, most of them, with a very small formal sector that is actually fairly heavily taxed per that formal sector, even if the tax to GDP ratio may be, of an order of 10 to 15% of that spread over the economy as a whole. So it's a matter of creating the ecosystem for the formal economy as we know it, and there are probably no real easy silver bullets there. I think that it's about building the business environment and skills and bringing in possibly some of the international management to build larger firms, building infrastructure and so on. I think there are some natural experiments in how much a fairly developed electronic system, say for tax compliance, can deliver in Rwanda, etc. And I think improvements in tax administration can help at the margin, but if they are applied to a very small formal sector, basically they don't automatically formalize the rest of the informal sector. So I think that the core answer is the long-term game, and in the short term, I think trying to also further improve the term structure and the currency structure of debt can help. I think most countries have made progress, but some countries have made much more progress than others. And I think some of the sort of in these discussions, there will be always some onus on donors to offer more. I think we will not go away from that either.
Sure. Thank you, Alex. And yeah, Vera, it'd be great to get your thoughts on the same question about what some of the emerging markets or those in sub-Saharan Africa can do to improve debt sustainability, given those threats that you mentioned earlier. Alex mentioned some of those points on improving, formalizing some of the economy, but perhaps also improving some of the market conditions as well. And maybe that would be interesting to hear some of the work you're doing with LSF on that front.
No, thank you. Thank you. Sorry, I was going through a tunnel, so my went off a little bit. No, I think three things. One of the things that we have neglected, yes, we've talked a lot about the fiscal policy side, but there's a whole monetary policy discussion that we could have where we could try to work on seeing how one reduces, improves debt sustainability. I think the first one is really, and we're talking about 10-year US treasuries and long-term emissions. One of the things that the continent still suffers from is a lot of short-term 7-year, 10-year offers, which are not optimal for the kinds of investment profile that they need. So one of them is just reprofiling the debt structures that they have. The second is working maybe a little bit more with, trying to get into indices where you get some additional capital from the fixed income managers that can be allocated to your countries. And we've just launched with S&P an LSF Emerging Markets Africa Sovereign Index. And we're hoping, actually, and it outperforms a lot of the EM emerging market bond indices now in the market, of course, because the yields are so high, but we can see them beginning to come down in some cases, and one can almost plot sort of the trajectory with the different crises that we have seen. Clearly, what that is providing is a diversification for fixed income investors that are sort of, getting into the US treasuries, but also looking at seeing how they can get a little bit, a few points more in return to see whether they can access some of these markets. The other thing that we're trying to do is, develop more the liquidity sustainability facility. It's a problem in many economies and in Africa.
I think we may have lost your connection, Vera. Apologies.
Oh, sorry.
I think we're struggling a bit. Maybe we can try and work on your connection and can move on.
Can you hear me now?
Yeah, that's a bit better. Maybe we can try on that third point again.
I just finished my 2 points. I was going to say one of the big issues that the countries are suffering with is the lack of a deep sector market. And so we're working on with the markets to see whether we can continue, because I think once we begin to provide liquidity into this market, hopefully the cost of funding the market is going to drop, and then we can manage, of course, the sustainability issue. And finally, I think what we need is improvements in the macro fiscal conditions. We need better investment conditions. We need to raise revenue. And I think one of the big areas where there is revenue potential today is the first market and whole conversation around so that we can actually price carbon.
Apologies, Vera. I think we've just lost you again. Maybe I'll try and come back to you in a few minutes. But from from what I caught there, I think she mentioned reprofiling the debt structure, which is something you touched on, Alex, and inclusion in indices and deepening the markets themselves to maybe help with access to financial markets. Hopefully we can come back to very shortly on some of those other points. James, maybe a quick word from you on the EM space. You had a few charts in the presentation on how you're seeing some of those EMs, and maybe what are they doing? What are some of those that are doing things right? You mentioned Turkey and Egypt, for example. Are there any others that are showing signs of optimism right now?
I think we have, yes, let me just check. We've got, I mean, obviously our main positive, on the positive side, let me just have a quick peep again to remind myself on the EM. There's certainly some public finance good news stories. Absolutely. We've been places like Jamaica. We've had on positive outlook. I think Oman, we've got on positive outlook. That's a WB plus. I think that's a public finance story as well. So there are Serbia as well. Various public finance story ones that are on a positive outlook in the EM. But yeah, I think really my point was we had a little bit of positive news on the sort of external finances situation, and Egypt got an upgrade clearly. Partly because of the significant inflow of foreign currency they got, but also because of a sort of a more, I suppose, prudent approach to some monetary policy and the rest of it. So seeing a significant improvement in the external finance, so they got an upgrade on a stable outlook now. So an upgrade with a stable. I'm not expecting the rating to go up. I still think the bigger one probably, and the one we get asked a lot about, is Turkey, where, again, a more conventional monetary policy framework saw a significant de-dollarization, significant improvement in FX reserves. And it had two notch upgrades. So it's probably minus now, but we're stable. I think, still at a situation where public debt is low there. But we're still at a situation where, inflation is still very high. And so that's the one we've been looking at. We've said we were looking at these sort of inflation numbers to see that coming back down, I think would be, our kind of focus for Turkey's rating at the moment.
Yep. Thank you for that. We've had a few more questions come in from the audience. Maybe coming a bit back to the defense point that was mentioned earlier, where James, you've mentioned that there was right now defense spending is about 2.5% of GDP average. I think you had an assumption it may go to something like 3%.
2.1, I think it is 2.1 median. Yeah.
Yeah, there was a question if that's just a simple average or if that's weighted. It's a slightly more technical question.
Median, because if it was weighted, the US spends 3.5%, so nearly 3 anyway.
And maybe just coming on to that broader point of course, one of the points that you raised was such that general geopolitical risks that there are in the world. Obviously mentioned that conflicts easing in the Middle East, but let's see what happens with Russia, Ukraine. But it seems like there's a general trend towards higher defense spending across the world, and perhaps particularly more so the case here in Europe. How does that play into the sort of longer term fiscal forecast? Is that I suppose, Alexander, maybe coming to you, is that what you're seeing as a big consideration by some of these countries? Is there an interplay there with how they're looking at industrial policy more generally in terms of sort of bolstering that their sort of whether it's with climate, whether it's supporting strategic industries, whether it's with defense, that governments essentially are having to do more right now?
I think the magnitudes involved are indeed non-trivial, and I think it was a very good question about that 2.1% median number quoted. The distribution is quite broad, and in fact, the countries in the south of Europe that were mentioned as examples of more responsible fiscal behavior have very low defense spending at the moment. I think Spain may be still below 1% of GDP or thereabout, although I haven't checked those numbers for a while. On the other side of the spectrum, Poland is at 4.7% projected for this year. And we see a shift up across the board, a considerable shift, but a lot of variation there remaining. Markets had been pricing in that geopolitical premium for a while at 0.5 to 1 percentage point extra spread relative to where it used to be and relative to Germany, US, say for economies in emerging Europe, including in the EU, in Central Europe and Southeastern Europe for a long time after February 22. And that has closed in recent months. for the first time. So now it's back to the same delta with Germany as it was back in or US back in February 22. So markets now have priced out or discarded that geopolitical risk, but it was a real extra cost of funding for a couple of years for these economies, for the public sector and the private sector alike. So I think that all of this is intertwined, but basically, if anything, the period where the peace dividend kicked in from the mid-1990s was more unusual, I think, on the scale of history of the 20th century, late 19th century, for which we have the data. So if one takes just a historical data-driven approach, I think the pressures to increase defense spending may be there to stay. We have also done some analysis whether these increases in defense spending are correlated with fiscal space, and they're very weakly correlated with fiscal space. So countries have to spend more on defense for reasons that have to do with their geopolitical positioning, but their political economy, and a little bit at the margin, they have to do with affordability of this fiscal spending. But affordability is not the main concern when it comes to defense spending, just empirically.
And I suppose there's been a follow-up question that if that new number on defense spending via NATO or through pressures from Trump becomes 5%, by extension, it seems like whether you have fiscal space or not, and then defense becomes a bigger pressure, that's something that will only add to fiscal pressures, perhaps.
It may come to that, but I think that as in the past, US would need to lead by example. And I think then the first question would become whether US can ramp it up to 5%. And let's assume it's a peacetime question, because I think in a wartime, the answer is obvious, but in a peacetime, maybe it's a question to Ernie or someone who covers US in much greater detail what kind of defense spending is reasonable to expect. And then I think from there, it's reasonable for the Trump administration to try to project that demand onto NATO allies to match, basically.
No, thank you. Maybe Ernie, it'd be good to bring you in about maybe just those broader structural trends and the fiscal implications for them in the US. You mentioned demographics before, perhaps defense or just the rolling impact of rising interest costs. How are you seeing all those factors play out over maybe the longer term horizon?
Yeah, so first of all, in terms of defense, right now the baseline projection is for defense spending to fall as a share of GDP. Now, I think realistically, the risks are skewed to the upside against that, given the sort of risk distribution of geopolitical possibilities right now. Right now in 2024, we spend 3.3% of GDP on defense spending. Next year, we're slated to spend 2.9% of GDP on defense. So I think I would probably pencil in, closer to 3% over the next 3 years as a result of that. But note that even if we spend 3% of GDP consistently over the next 10 years, that's still only about 0.5% higher, even in the out years, than what's being projected by CBO right now. So that's not substantially more than what's being projected right now by CBO. That pales in comparison, for example, than the difference between extending or not extending the 2017 tax cuts. So the tax cuts are still by far the bigger, fiscal difference. Interest rates, I think that interest rates and growth are by far the bigger consideration, and that's by far the bigger uncertainty right now. And the big factor there is productivity and labor supply growth. So let's take labor supply. So we still don't have a good handle right now on what has happened in the recent past with labor supply and immigration growth. The data are, we're still getting a handle on the data over the last 2 years. And so therefore projecting it over the next 10 years is highly uncertain. Add on top of that, of course, the policy uncertainty this year, let alone the next 10 years. But I think it's fair to say that whatever we had in terms of a growth premium from labor supply over the last couple of years is very likely going down over the next 10. And just to put it in perspective, we probably got an extra half a point of surprise from labor supply over the last 2 years on average on an annualized basis to real GDP growth. So that's probably going away. And then on productivity, so, this is so. On productivity, my sense is that a lot of this productivity gain that we've been getting, some of it might be coming from AI. Look, I love AI. I use it all the time. I'm a little bit skeptical that we're seeing it in the national accounts data right now in a measurable way. I think a lot of the growth surprise on the productivity side is probably the echo of the earlier labor market churn that we saw earlier in the pandemic. So we saw this rise in quits in the United States, which was a consequence of the way that we chose to support people in the pandemic, which was primarily through checks rather than furloughs, which was the way that Europe primarily chose to support people. When you give people checks, you sever that employer-employee relationship. They quit their employer, they find a new job. If they find a new job and if that match is better, you initially get a fall in productivity because they literally find a new job. They're learning how to turn on their computer. But if that match is better, then in the longer run, you get an increase in productivity. And I think that right now we're getting that temporary sort of that surge, that consequence of that. And if I'm right about that, then that means that this is a temporary consequence of this, that this will eventually go away, and that underlying productivity probably hasn't changed from prior estimates of trend of 1.5%. And indeed, if you look at estimates of total factor productivity from Fernald, for example, they haven't changed at 1.5%. So I think that that's probably where we're going in the future.
Right. Thank you for that. Yeah, Tom, I was just about to come to you on that, but yeah, go ahead.
So just echoing off, I'll get to the defense part in a second, but I think another thing, I don't know if Ernie mentioned this, but it kind of ties into the industrial policy part. The investment cycle in the US is by far the strongest on a percentage basis out of all the developed markets that I'm looking at. It's positive. It was negative in Germany. It was negative in France. And that is also, if that's productivity enhancing, that works. And I think that the industrial policy part of that is the CHIPS Act, is the Inflation Reduction Act. These are to some extent subsidies, and the U.S. is seeing the largest inflow of FDI, largest inflow in equities. People are voting with their wallets, and I think it's just a matter of time before other countries do the same. And so I think that'll be a big shift. I think the U.S. has just done it earlier than the other places. On defense spending, I think it probably, in my opinion, it probably matters less for the U.S. I think there is a drastic shift in political will. The two factors, obviously, being the war in Ukraine and Trump. Just looking at it, in NATO in 2013, 3 countries met their target. This or last year, 23 did, which is 2/3 of NATO. I don't think this is going to change, and that's a big shift. And I'm going to give Germany as an example because I think this is important. Because Germany has this debt break, the increase in defense has been constraining on Germany. In order to hit that defense target, Germany has to cut in other places. And so what they've been doing, it's cutting investment in their economy. And it's become painfully obvious to the electorate, and they're not liking what they see. And so I think that's why this has become a big talking point in the election. It's the defense spending is crowding out other parts of the fiscal space. And it's true, the Southern European countries haven't done that much. Canada is the other one that shows up in that. Interestingly enough, very good fiscal outcomes. But they've never had that fiscal crowding out of defense. And so I think, this is a question. We'll see what President Trump does. But if he goes to Canada and the Southern European countries and says, "Hey, this is not acceptable," I don't think they're going to be, the big outliers that they have been over the past few years. They'll run into the exact same problem that Germany's running into.
It's an interesting point, and I remember seeing a chart which is in some ways self-explanatory, but it's quite interesting to see that it was just distance from Moscow and defense spending, and essentially those that were further away from Russia spend less, like the likes of Spain and Portugal and the other ones that maybe aren't hitting their NATO targets. Whether that continues remains to be seen. James, I want to come back to you maybe on some of those defense points that you've just heard, but also we have a question about any risks of EU countries going downgraded below investment grade right now as well.
Any risk of EU countries going below investment grade? So on negative outlook, we've got nothing anywhere near the investment grade cusp. So I guess the answer to that would be no, based on just simple maths of the rating levels and the outlooks. So I think that would be the answer to that. And defence, do you have a question on that? I mean, I think broadly I agree with pretty much everything that's been said by Thomas in particular. He said a lot of truth, that there's a strong link between some of the peripheral former Eurozone crisis countries and having lower levels of defence spending. That's very clear.
I suppose one question is, I mean, there was that striking chart you had of just the current, I think it was the EU spending, and then those indicative forecasts for defence, climate, interest, ageing, etc. I mean, it begs the question. I mean, we're already seeing many countries facing difficulties now, and if those pressures are only going to get worse, and as you say, it doesn't seem like EU fiscal rules are much of an anchor in many cases. I mean, what is it that countries can do to alleviate some of these costs, or is it just this sort of negative trajectory likely to continue?
Well, I think given as what I said, that I mean, of course, we can't sort of give advice, but the issue in Europe is mainly is where there are the sort of pressures on the government finances, on the budget deficits are larger and debt ratios are deteriorating. It's really due to the cost side of things. Ultimately, that's where we've seen the pressures. I gave you a few data points. Euro area average 50% of GDP is the expenditures of 50% of GDP. That's a high number, and it's a sticky number. France is 57%. It's a sticky number. There's a lot of inertia. There's not much social sort of desire for the numbers to come down. There's not much political there's a sort of political inertia. There's quite a lot of rigidities in the system that sort of mean that sort of ratchets up, as well, indexation and whatever it might be, or some of the cost bases. So, that if that's where we see the deterioration having come from, the logic of it would be is that's where there could be some sort of safety valve, I guess, ultimately. But at the moment, from what we see is inertia. There's a lot of inertia, a lot of rigidities in the system. It seems, I gave that data point, 10 percentage points higher in the pandemic, comes back 7 percentage points, doesn't come back 10 percentage points,
Yep. And I'd encourage the audience to submit their questions while we have the last few minutes. But I think one big country we haven't really mentioned yet is China. That's one of the countries on your negative outlook list, James. Maybe a quick word on that and how you see that playing out and why it's on negative right now.
Yeah, it's on negative. Clearly it relates really to the sort of expensive transition away from a sort of property-based economy. Clearly, the export sector has been going extremely strongly, but domestically, that there's severe weakness in the property market, and consumer confidence is extremely low. So we have been sort of revising down our growth expectations. I think we were at 5 last year, but 4.5 or something this year, and a bit lower even next year. That's based on a sort of 60% dutiable tariff rate factored into that sort of thing as well. And really the fiscal deterioration, I suppose, has been, I think, interestingly there, it's more of a revenue story. If you go way back, there were some tax cuts way back before my time, with some tax cuts, VAT and I think corporate taxes. But also, the receipts from property sales is a big deal for local governments, and we have a sort of general government debt sort of metric where we sort of consolidate the sort of the debt metrics of the central and local governments. So that has been the sort of revenue issue there. So you've seen pressure on the revenue side, I suppose, is what's been driving the deterioration of the budget balance. And we have a pretty wide deficit this year. I think it's I think we may even be as far. I think we're over 7% anyway for next year, maybe. And so the debt dynamics it's all about the debt dynamics deterioration, really, and related to the sort of transition of the economy away from a property-related economy.
Yeah, great. One very quick final question from the audience before I pose my final question to you all. I think, Tom, you'll be best placed for this, about how financial markets would incorporate the increase in defense spending, bearing in mind that you mentioned it may crowd out other areas of fiscal spending, although, as perhaps we heard earlier from Alexander, to the extent that it may reduce geopolitical risk premium. How do those two balance out, do you think?
I'll give a very simple answer and say that means interest rates will have to go up, specifically real interest rates. I think the market have already figured that out to some extent and already increased real interest rates. I think the interesting one is Germany again, because it kind of, you have this fiscal straitjacket, so you need to shift around the building blocks, the Legos of fiscal policy a bit. And so real interest rates haven't increased as much in Germany. But if you look at the UK, if you look at the US, the places that have been really spending a lot more on defense or anything else, it's already been adjusting. And so I think that's the method. I think what's interesting is at some point is if we get a fiscal reckoning from the market, meaning the market puts back some fiscal discipline in DMs. It's interesting enough. I think Alexander mentioned earlier about EMs. EMs know this, right? They've done this before. They've gone through this, and DMs haven't really. The UK learned it pretty brutally with the mini budget. But I think it's just a matter of time before some other countries fall into that. And so I think that's the big question. But in the end, it means interest rates will have to go up much more long-term over long periods of time and stay higher. So going back to the question of where interest rates are, maybe the last 10 years were a massive anomaly, right? And in fact, real interest rates and nominal interest rates should be more 4 to 6%, which causes a lot of problems, like Ernie said, for the US. But even countries that I think people don't, we haven't really talked about at all. The biggest debt load by a government is Japan, with interest rate effectively at zero. Let's say interest rates go up there a significant amount. That is a country that's that will face it in a very different way than the UK did, than the US will, and even the way that Europe did.
Yeah, no, thank you. Yeah, that's interesting point to note. I'm conscious we're going into the last couple minutes, and one maybe very quick final question to you all, if you could answer in perhaps 30 seconds or so, is just in many ways, what is the key trend that people should be looking out for in that fiscal or public finance space? We've obviously mentioned a lot of things here: tariffs, tax cuts, defense, Germany, France, Japan, perhaps. But what is the one thing front and center of your mind right now as you're looking at this public finance space? Maybe Vera, I think it's great to see you back. Maybe just a quick point on your side. What is that one thing that's front and center of your mind right now on public finances?
Was that for me? You wanted me to come in first?
Yeah.
No, I think for emerging markets, the biggest issue is how are we going to get out of that distress? How are we going to find the kinds of resources? In some sense, it's a little bit of a chicken and egg. For us to be able to improve our debt profiles, we're going to have to grow. To grow, we need investment. And so I think where we are going to need, and I think it was mentioned before, some external financing. There is going to be the need for some cheaper external financing to blend with the debt. I think there was just an operation that the World Bank did in Cote d'Ivoire, which is a debt for development swap using guarantees. I think that what has happened in the IMF and the World Bank is there's additional capital now that I think we must be able to deploy at scale to help those countries, begin to invest and not just continue restructuring and extending the debt profiles. I think we need to go into investment. So for me, the biggest one is, where do we find cheap, affordable, long-term resources to go beyond just debt restructuring into investments and growth?
Great. Yeah, thank you. Alex, coming to you next.
Two things probably, really. I think the ability of economies to turn the burden, such as defense spending, into advantage. There is a lot of skill and luck in it, but ultimately things like internet came out of defense spending in part and can be a big part of productivity enhancement. And the other one for advanced and emerging markets alike, social cohesion and the ability of the society to agree and follow through on some kind of fiscal consolidation path. Just by way of example, countries like Greece and countries like Latvia probably had a very similar post-crisis adjustment problem in 2009, say, but they had to adopt very different strategies in dealing with it, depending on what was feasible and acceptable in the society.
Thank you. Ernie, same question, the one thing you're looking out for right now.
So in the US context, it's a little bit different. We don't have a growth problem. We've actually solved the growth problem, I think, more than other advanced countries. We have less of a demographic problem than other advanced countries, although to the extent that we push against immigration, we might have more of a demographic problem than we've had. The question for us is, what hard choices are we going to make the debt sustainable over the next 10 years? Like I said, even before we get to the 2017 tax cuts, it's going to take $8 trillion in deficit reduction to make that sustainable. Even if we go through an enormous amount of political back and forth to pay for the 2017 tax cuts, to find $5 trillion in pay-fors, we would still need an additional $8 trillion to make that sustainable. So my question is, what are we going to do to make that happen?
Right. Yeah. Thank you, Tom, and then I'll ask James to have the final word. But yeah, Tom.
Thank you. And thank you for having me. I'll be very brief. From a market standpoint, I think it's very simple. Is the last, let's say, 20, 30 years has been basically about monetary policy, looking at every Fed statement, looking at what the chairman of the Fed does, and ECB and every other central bank. I think the next 20 years will be more about the political economy, be about fiscal policy. I think showing the limits of that will be very interesting to watch, and will take probably a very different skill set and very different sense for the markets than I would say the last 20 years have.
Yeah, thank you. And James, to wrap up.
Yeah, I think probably I would look to the US. I think part of the same things that Ernie's looking at. I think the US fiscal policy, and trade policy, I think that's just so important, so consequential beyond its borders. I would say that would be the thing we'll be looking at as well this year, if you were to ask me to pick sort of one US policy, I guess.
Great. And I think with that we'll end there. I think it's been fascinating discussion. We've touched on so many areas within the public finances space and different geographies and different issues. So I hope, like myself, I hope that the audience has taken plenty away from that discussion today. That leaves me to thank James, to Tom, to Ernie, to Alex, and to Vera for your insights today, and to thank everyone for tuning in. And so, with that, I'm sure there'll be plenty more discussions that we'll be having on this space, perhaps as Tom mentioned, not just this year, but perhaps over the next 20 years or so. Thank you for joining us, and have a good day.
Bye.